Despite the ongoing mass layoffs, skyrocketing credit card debt, and the 2008-style housing crash that has hit 4 major cities in the U.S., a new theory is emerging in the markets: the possibility of no recession after all. The economy grew by a commendable 2.9% in the last quarter of 2022, and companies like Tesla reported record revenue and a strong outlook for this year. Chipotle plans to hire 15,000 new employees as they prepare for the upcoming burrito season. However, while the economy appears to be thriving, the reality of the situation is far more complex. Rent prices continue to soar, and Michael Burry, a well-known investor, has called the latest stock market rally a mirage. Furthermore, Congress's decision to eliminate the IRS entirely has raised concerns, and the possibility of nationwide rent control looms. The topic on everyone's minds for the past year has been the possibility of a recession, with numerous warnings about the difficulties that lie ahead for our economy. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. From the Federal Reserve tightening to the U.S. government scaling back on stimulus, analysts were right when the S&P 500 officially entered the bear market on June 13, 2022, having declined 20% from its peak. Despite the numerous indicators flashing recession warnings, analysts are now saying that there's a chance there may not be one after all. But what happened, and what's the catch? Technically, a recession is defined as 2 consecutive quarters of declining GDP, which already occurred in the middle of 2022. However, since GDP isn't always a true indicator of the overall economy, the National Bureau of Economic Research updated its definition to include a significant decline in economic activity that could last from a few months to more than a year. The White House had given us a heads up about the updated definition of a recession, clarifying that there are no set rules or criteria that automatically indicate a decline. Instead, the National Bureau of Economic Research takes into account a range of factors such as real personal incomes, payroll, employment, and sales, which are tracked on a monthly basis. This means that the announcement of a recession is usually made after the worst is already over, and there is typically a delay of several months before it's confirmed. Comment recession if you would like us to make more videos on interesting topics like this. However, the Bureau takes this time to ensure that its declaration is accurate, as they have never had to retract a recession declaration in its 45 years of operation. In the current situation, some experts believe that even though we did see 2 quarters of negative GDP, one of those quarters may have been artificially low due to businesses stockpiling resources in advance to deal with supply chain issues. Additionally, the job market remains relatively strong, which is a positive sign. For example, a paper from the San Francisco branch of the Federal Reserve found that the current job market is healthier than it was during the 2008 recession. According to the Federal Reserve, the yield curve is not as accurate of a short-term predictor of a downturn as an alternative measure of unemployment that considers individuals who are temporarily out of work but likely to be rehired quickly. The Fed also notes that despite concerns about a possible recession, consumers' net worth has increased to $145 trillion, up from pre-pandemic levels of $115 trillion, and average housing prices remain significantly higher than before. Therefore, they argue that a recession is not currently a danger and that they can continue to raise interest rates until inflation subsides. However, this is only part of the story, as some markets, such as the housing market, are starting to see significant declines. Remember to give this video a thumbs up if you've watched it all the way through now, as it inspires us to create more engaging content just like this. For instance, Goldman Sachs predicts that San Jose, Austin, Phoenix, and San Diego will experience declines of over 25% from their peak home prices, which were inflated by unsustainable price growth. Moreover, Goldman Sachs suggests that home prices peaked in June 2022, and a 10% decline on a national basis could be seen before growth starts to recover in 2024. Morgan Stanley, Wells Fargo, and Interactive Brokers have varying predictions on the decline in housing prices, with some expecting drops as high as 20%. The proposed Renters' Bill of Rights seeks to limit rent increases and prevent tenants from being unfairly denied housing, but economists generally agree that rent control does not address housing affordability issues. Despite this, some states such as California have implemented statewide rent control, and members of Congress have expressed interest in expanding it nationwide. The effectiveness of rent control remains a topic of debate in the housing industry. The American Economic Association conducted a poll in 1992 revealing that 93% of its members believe that rent control results in a decrease in both the quality and quantity of available housing. Moreover, a study by Stanford University discovered that rent control policies have an adverse effect on rental prices and housing affordability. The study found that renters in rent-controlled buildings were more likely to stay in their units, while landlords were more likely to convert their buildings to alternative uses, leading to a 15% reduction in housing supply. This reduction in housing inventory, even as demand remained constant, led to a 7% increase in rental prices. Furthermore, most rent-controlled properties in San Francisco were converted into condominiums and sold to wealthier residents, exacerbating the housing shortage. Rent control may lead to lower property and income values, resulting in less tax revenue for cities, as there is no incentive to invest in the properties beyond the minimum required. According to the proponents of this bill, the solution to the IRS's inefficiencies is not to hire more agents to target small business owners in Middle America, but to simplify the tax code and create provisions that promote growth and innovation. Some argue that eliminating the income tax entirely would leave individuals and businesses with more money to invest in expanding their operations, ultimately boosting economic growth. However, implementing such a plan would be a logistical nightmare given that each state is responsible for administering and collecting sales tax. Moreover, a 30% sales tax would be difficult for many Americans to swallow, leading to less spending and potentially stalling economic growth. Although a simpler tax code and more responsive IRS agents would be beneficial, it is disappointing that resources have been allocated to a doomed-to-fail proposal. The priority should be fixing the current system's inefficiencies before implementing any new plans. Whether or not a recession is on the horizon, it should not impact the future direction of the market. Even if GDP declines, if the unemployment rate does not significantly increase, there is a chance that the Federal Reserve's soft landing will be successful. However, there are also concerns that the current stock market rally isn't sustainable and may lead to a decline. Only time will tell whether the worst is behind us, and we must look to the Federal Reserve for guidance.